Alright guys, so in this video, we're going to talk about the importance of being in multiple markets. Now, everybody's invested in crypto and in stocks, but they're not so much in the bond markets or in the commodities markets. This is mainly because investors are looking for a higher rate of return, and you just don't find that mainly in these markets. But I'm here to convince you guys that you should have positions in these markets actually. Now, there's like three main reasons why you should be invested into these markets that have lower rates of return. Well, for one, not all of them do have lower rates of returns. Some of them have more, but we don't know that, or you don't know that because you're just not familiar with these types of investments. And when you're investing, you should always be familiar in what you're investing in. So, it doesn't hurt to learn about these other markets. Number two, these markets also move differently than, say, the stocks, how they move, or how crypto moves, or how bonds move. They all are interrelated and play a part or a factor how each other move, but they also serve as safety nets or precautions for if one market goes down, the other should go up. And then three, just to learn. So if you're more familiar, like I said, with all these types of markets, then you have an advantage and you can maybe predict and see what's going to happen next based off of how, say, one market is doing at one time. All right. So it's time to talk about the investments for y'all. You don't gotta just diversify your stocks, but the whole portfolio. You don't want just the stock market, like all your money in the stock market. You got all your eggs in one basket, Humpty Dumpty. You don't want to end up like Humpty Dumpty now, do you? So, underappreciated investment is cash. A lot of people say you shouldn't have a set percentage of your portfolio cash because of inflation, you know, the silent killer cash, but it is true. Like $100 worth $100 in 1913. Now, as you can see, it's worth under $10. But if you're not prepared for situations like now, like you wouldn't be able to dollar cost average down on your stocks and could end up fucked. Better safe than sorry, I always say. So these Roth IRA, traditional IRA, they're not necessarily markets, but they're ways to help diversify your portfolio. Like, this picture depicts when you should have a traditional IRA, and the bottom when you should have a Roth IRA. These help prevent tax for your cash, really, but different times for each. Like a Roth IRA, the money's taxed at first, but once you take it out when you're 60, no tax. Traditional IRA is the opposite. You put that in at first, no tax. But then when you take it out, it's going to get taxed. Indexes. Alright. These are most popular. I will always sponsor recommend indexes. Everybody, a majority of your portfolio should be indexes if you're new. Definitely. These, most popular one, S&P 500. Top 500 stocks in America. If one isn't doing good, you got 499 other. And they're not bullshit companies. These are companies been around and they got money. Real estate. Now something similar to indexes, exchange traded fund, ETF. This is another way of investing in multiple types of companies, or just the same types of company. It all depends. They got different types of ETFs, really. It could be based off of indexes, based off of certain commodities, based off of certain sectors, say just an EV sector. Everybody love ganja sector, you know. But ETFs and indexes are very similar, as you can see in this picture. Mainly, the only differences are you need a lot more to invest in indexes, and indexes are traded only once a day, while the ETF is traded more so like stocks and in real time. So the price is changing constantly throughout the day. Now what do we got next? We got some stocks. Everybody knows about stocks, but do you know all the different types of stocks? So, most popular that everybody should be investing in is blue chip stocks. These are like your Apples, your FANG stocks, It's Facebook, Amazon, Apple, Netflix, Facebook and Netflix, Google, Microsoft, blue chip stocks, nice, sound companies. Then you got your dividend stocks. I love preaching these dividend stocks, They paying out money constantly, whether the stock is going up or down. I like that. Then you got growth stocks. These are a little more risky, like your Square or PayPal, companies that are getting hit right now. So if you want to buy the dip in your growth stocks, but be prepared for more dips because growth stocks are volatile. Blue chip stocks, dividend stocks, not volatile. If you got balls for that, then I suggest you go into your growth stocks, but have some balls. Now, if you got patience, get into your value stocks. That's like stocks like Alibaba, where it's a good company, but the price does not show that. It shows that this company is getting oversold. This company is not worth what it said. It's worth more, but who knows when it's going to be this company's time again. So you might be losing money for a little bit, but hey, I'm getting a deal right now, and in time, it's going to pay off. Now, companies you definitely should not be investing in right now is SPACs and IPOs. So IPOs is when a company first comes public and enters the stock market. Boom, it's an initial public offering. Then you got SPACs. These are companies more lucrative. They don't really have their whole shit set up yet, and they just went public because they are waiting for a company to merge with them. So I don't recommend that. You're gambling. What we got next? Mutual funds. Now, this is very similar to your indexes and ETFs because it's a group of stocks, a group of bonds, a group of whatever. It's mainly bonds and stocks, mutual funds. But the most popular mutual funds are T. Rowe, Vanguard, and Schwab. Now right here in this little depiction, it shows the difference from a mutual fund and an ETF, and also the similarities. So mutual fund, the one good thing that I like about it is actively managed. So it's consistently making little corrections here and there, changing up how the portfolio is investing in certain companies. It changes up the percentage and moving with the time of how the markets are doing. When you're ETF, it's not it's set, and it changes up, but not as actively as a mutual fund. That's for damn sure. Mutual funds, good way to be safe. I recommend ETFs, indexes, and mutual funds. You should definitely have a decent amount of those if you're new to investing. Now, commodities, they are less volatile than all the markets we were just talking about. They barely move that much, but they do move for damn sure. Most popular, everybody says you should have a majority in the S&P. You should also have a majority of your money in gold because, hey, thousands of years ago, gold was it's valuable. In 1,000 years, gold will be valuable. Now, it doesn't have the growth, per se, that a lot of companies have, but it has that play where, right now, people are scared. They won't be as scared to put their money into gold. But also, other commodities that are always popular, you got other ones, too, your soft ones, orange juice, cotton, cocoa, coffee. People always been using these. Or energies, commodities, heating oil, natural gases, gasoline. It's constantly being used and constantly will have its purpose. And not even just that, it's easier to predict. Each of these things have its seasons and have its main time of usage, and you can predict when that is going to go up. So that's the one good thing about commodities. It's a really good safety net. It's not volatile, and it's good to have your money. If you always need money too, like cash to buy that, you take some out of your commodities, and then boom, it's good to have your money in commodities. I'll back that, even though it's a little scary. But bonds, people are scared to say they got their money in bonds right now because, hey, they don't really go up. And they are not going up right now, they're just going down. But you should still, like I said, have it in different markets, but just don't have as much really. Just for a rainy day, you got your bond money, take that out, put it into something else if you need to. But for one, there's a lot of different types of bonds too. The one I would preach right now is Treasury Inflation Protection Securities. So with inflation, how it is right now, it's a nice little bond to have. But then you can have bonds for corporations, or you can have bonds for like the government, or you can have bonds for, say, like other global economies. And it all depends like how much of a percentage you want to make like your portfolio more conservative or more aggressive. And this little depiction shows like what it would consider an aggressive portfolio or conservative portfolio. When you're buying your bonds though too, also make sure you're looking at the ratings. You can have like AAA to like CCC. Like you want the AAA, you want more A's. We get A's on our report cards, you know. And you want those C's, not average. Another one is REITs. We want some REITs, or real estate investment trusts. Let you invest in real estate basically if you just got a little bit of money. These are like the top REITs I would recommend. And right here it shows like basically the percentage of how much you should be investing in real estate investment trusts. As you can see, as you get older, you put more percent in. That's because like mainly you don't see that much of a return in these, but it's more like a dividend play. Like if you have more, so you need more monies to have a dividend play. Because at first it's just the journey of putting money in. So once you have this much money in that dividend stock, then it's finally you see the payout. But at first you're not seeing the payout. So that's why at first you just slowly put your money into it, so then you receive that earnings at the end, where it's a lot more consistent, a lot less risky than stocks. You want stocks like that when you're retired, not the risky shit. Now is the time when if you're a kid, to have the risky stocks. What we got now, foreign exchange. So this is just like basically all the currencies around the world being compared to each other. These are the top ones right there. And yeah, like you should definitely invest in like all these currencies. They're not gonna go to shit. Like I know there's crypto out there, but we're definitely going to still use our national currencies, and they're definitely going to be here for a good amount of time. It's just great to know. Great, like economics is a huge factor in stocks, and if you understand Forex, you get to understand a new level of economics that can help you day to day in stocks. It's probably some crypto shit. Everybody know about crypto. Everybody investing in crypto. So I ain't gonna say the definition, but if you're investing in crypto, you better just have these stocks, you know. It's said that only 26% of adults have Bitcoin, and that shocked me honestly. Like, I know a lot of people are skeptical of it, a lot of people aren't in it, but a lot of people are. I wouldn't just think 26% honestly. So like, it is showing this is just the early stages still of crypto. Now NFTs. Everybody probably talking about NFTs too. Just buying art for overpriced prices, in my opinion. If you buying NFTs, you better have a nice little art collection too. Like, if not, you just doing it for the hype and for the everything. Like, but that's basically all it is. It's having a nice little art gallery, nice little collection for investments. Anyone who invests in art's basically the same thing, except for it's digital. These are the top companies: Bored Ape Yacht Club, CryptoPunk, and you can buy even land in the metaverse and stuff like that. So finally, we got CDs, a certificate of deposit. These are fixed incomes, where you know exactly how much you're going to get, but you will definitely get it. But you gotta wait till the maturity date, and that's like how long you say it's 5-10 year CD. You gotta take it out in 5 years, and then you definitely get the money that you said you were gonna get. But the interest rate on that is very low. Coupon rate, interest rate, whatever one is, it's really low, and it's worth. If you want like a safe investment, like gold or something like that, bonds, get a CD. Like, your kid born, you get your kid a CD, you know, you get your kid a bond. It's not that fun, but investing not always fun. It's about principle and discipline, you know. And one of the main things, diversification. And this video just shows you all different ways to diversify.